Imagine holding two assets in your hands. On one side, a gleaming piece of gold, trusted as money for thousands of years. On the other, Bitcoin, a purely digital creation, born in 2009, whose short life already questions the control governments have over money. Which one truly preserves your wealth in a world of inflation and central bank printing? Both are celebrated as hard money. Both are praised by their supporters as the ultimate hedge against inflation and government overreach. But which one truly aligns with the principles of the Austrian School of Economics, the ideas of Ludwig von Mises, Friedrich August von Hayek, and Murray Rothbard? In a world where central banks print trillions, distribute fiat money like confetti, and continuously lower people's time preference, this question is not just academic. It determines how you protect the wealth you've worked hard for, and perhaps even what kind of society we will have in the coming decades. In 1971, President Nixon ended the last remnant of the gold standard. Since then, the US dollar has lost over 85% of its purchasing power. Today, we examine this topic strictly from the Austrian perspective. No hype, no tribalism. Only a consistent application of praxeology to two of the most important monetary phenomena of our time. The Austrian School of Economics is not just one school among many. It is the consistent attempt to derive economic science from human action itself, from praxeology. Mises demonstrated in The Theory of Money and Credit, 1912, that money cannot be created by the state, but arises spontaneously on the free market, following the regression theorem, which shows that it must have had prior commodity value. Building on this, Hayek warned throughout his life against the pretense of knowledge by central planners, showing in The Road to Serfdom how government control of money can lead to totalitarianism. Rothbard took these insights further, advocating in What Has Government Done to Our Money? For a fully free banking system completely separated from state privileges. Within this intellectual framework, we examine gold and Bitcoin today. Gold represents centuries of market-selected money. It has accompanied humanity through empires, wars, and currency reforms. Bitcoin, on the other hand, is the first serious experiment in decentralized, digital scarcity without physical substance. Many Bitcoin maximalists claim that Satoshi Nakamoto finally put Austrian theory into practice. Many gold advocates, however, see Bitcoin as nothing more than a highly speculative digital tulip bulb phenomenon. Both sides are partly right, and both miss important points. We will proceed systematically in this video. First, we clarify what constitutes good money from an Austrian viewpoint. Then we analyze gold and Bitcoin individually against these criteria. Afterward, we make a direct comparison. And finally, a sober assessment. For the Austrian school, it's not about picking a winner. What matters is which asset best supports a free market, encourages patience by lowering people's time preference, and provides a stable unit of account. All without coercion or inflation. In this video, we'll explore the clear strengths and tangible weaknesses of both, illustrated by historical examples like the Roman denarius debasement, the 1933 US gold confiscation, and the hyperinflation of 1923 Weimar Germany. Have you ever wondered what makes money good? From the perspective of the Austrian school, money does not arise by decree, but through the market process. Mises describes in The Theory of Money and Credit the regression theorem. Money must have had a previous non-monetary exchange value in order to be accepted as money. Good money fulfills three core functions exceptionally well. First, medium of exchange. It must be universally accepted, easily divisible, portable, and counterfeit resistant. The lower the transaction costs, the better. Second, unit of account. It must provide a stable foundation for economic calculation. Without a stable unit of account, entrepreneurial action becomes a lottery. This is one of the greatest damages of fiat money. Permanent money supply expansion destroys the possibility of rational economic calculation. Third, store of value. Money must retain its purchasing power over time as well as possible. This is closely linked to scarcity. Hayek emphasized that inflation distorts price signals and leads to malinvestments, the famous Austrian business cycle. Additional crucial properties from an Austrian perspective. Key characteristics of sound money, from the Austrian perspective, include extreme scarcity, minimal influence from central authorities, the ability to encourage long-term thinking, and emergence through the free market rather than state coercion. Gold meets these criteria with an annual supply growth of only 1.1 to 1.5%, World Gold Council, while Bitcoin is mathematically capped at 21 million coins. Both are resistant to central control. As Rothbard put it, central banking is legalized counterfeiting. Sound money also lowers time preference, promoting saving and future-oriented decision-making. Fiat money fails on all fronts. The Weimar Republic's hyperinflation of 1923 in what is now Germany made a loaf of bread cost 200 billion marks, and today's quantitative easing continues this pattern on a global scale. Gold and Bitcoin can be seen as natural market responses to these failures. Fiat money fails on almost all of these points. It is artificially expanded to finance government spending and credit expansion. This lowers the savings rate, increases time preference, and creates boom-bust cycles. Rothbard called this legalized counterfeiting. Both gold and Bitcoin are seen as alternatives to the fiat system. But how well do they actually meet the Austrians' criteria? Let's examine them closely. Gold is, for the Austrian school, not merely a precious metal. It is the historical prime example of spontaneously emerged market money. Therefore, gold won the free market competition. Ancient Lydia, an ancient kingdom in western Anatolia, modern-day Turkey, minted the first gold coins around 600 BC. Mises and Rothbard repeatedly emphasized that gold established itself over centuries in the free competition of goods. It was not decreed. People chose it because it possessed the best monetary properties: durability, divisibility, portability, relative to its value, relative scarcity, and above all, its production cannot be expanded arbitrarily. Historically, gold provided stability. Between 1821 and 1914, under the British gold standard, inflation averaged near zero. Trade boomed. Time preference dropped as people saved confidently. Rothbard highlighted gold's resistance to manipulation. Even kings debasing coins, like Rome reducing silver content in the denarius from 95% to under 5% by 270 AD, could not fully destroy its value. People reverted to gold and silver. The scarcity of gold is geologically determined. Even with modern technology, the annual supply increase is only about 1 to 1.5%. This acts as a natural brake on inflation. Unlike fiat money, which central banks can multiply with a keystroke, gold must be laboriously extracted from the earth. This corresponds to Rothbard's demand for 100% reserve banking and genuine commodity money. Gold has an extremely long track record as a store of value. Across empires, wars, currency collapses, and civilizations, it has preserved its purchasing power remarkably well. It lowers time preference. Those who save in gold know that their grandchildren will likely still find value in it. However, gold also has important weaknesses, which Austrian economists were always careful to point out. Being a physical asset, it requires secure storage, insurance, and careful transport, which can be slow and costly, especially for large amounts. In 1933, the U.S. government issued Executive Order 6102, forcing citizens to surrender their gold at $20 $2.67 per ounce, only to later revalue it to $35, effectively seizing around 40% of private wealth. Gold also lacks easy divisibility for small or everyday transactions, making it cumbersome in a fast-paced digital economy. While it can be hidden, it is far less convenient than a simple 12-word seed phrase for digital assets. Furthermore, the threat of state coercion, such as gold confiscation or ownership restrictions, remains a practical risk, reminding us that even historically trusted money can face serious limitations. Nevertheless, gold remains the proven foundation from an Austrian viewpoint. Hayek wrote in The Denationalization of Money that a return to a gold standard could be desirable as long as no better spontaneous order emerges. Gold has proven it can function as a unit of account. See the classical gold standard of the 19th century, which brought a period of remarkable price stability and economic progress. In summary, gold is the historical product of free markets. It perfectly embodies the Austrian skepticism towards central planning. Now let's examine Bitcoin through the same rigorous Austrian lens. His strengths. Bitcoin represents the first successful attempt to create digital scarcity without a central authority. From an Austrian viewpoint, this is revolutionary. Satoshi Nakamoto solved the double spending problem through proof of work and a decentralized blockchain, creating a form of money that emerges purely from voluntary network consensus, very much in line with Hayek's idea of spontaneous order. Bitcoin has absolute scarcity. Only 21 million coins will ever exist. This fixed supply is hard-coded and cannot be changed without destroying the network's credibility. In a world of endless fiat printing, this makes Bitcoin the hardest money ever invented in terms of verifiable scarcity. Rothbard would likely appreciate this as a market-driven solution to the problem of legalized counterfeiting by central banks. It excels as a medium of exchange in the digital age, borderless, permissionless, and easily divisible down to 8 decimal places. You can send value across the planet in minutes without asking any government for permission. This aligns with the Austrian emphasis on individual sovereignty and free exchange. Bitcoin also dramatically lowers time preference for those who understand it. Holding it encourages long-term thinking because its supply cannot be inflated away by politicians. Let's now look at his weaknesses. The blockchain is both a blessing and a curse. It is a blessing because it provides perfect transparency and immutability. No central party can secretly inflate the supply. Every transaction is visible forever. However, it is also a curse. Everyone can see who sends how much to whom. This lack of privacy creates serious problems for a true medium of exchange. In a world of surveillance states and financial censorship, perfect transparency can be dangerous. Mises and Rothbard emphasize the importance of sound money, enabling private property and discrete free exchange. Bitcoin's public ledger undermines part of that privacy. Furthermore, Bitcoin's price volatility remains extremely high. This weakens its function as a unit of account and reliable store of value in the short to medium term. While its long-term trend has been upward, the violent swings make economic calculation difficult. It is still primarily a speculative asset rather than everyday money. Energy consumption for mining is another point of criticism. From the Austrian perspective, gold remains the proven, battle-tested sound money with centuries of market acceptance. Bitcoin is a groundbreaking digital innovation that brings absolute scarcity and strong censorship resistance, though it still faces challenges with volatility and privacy. Both represent far better alternatives to today's fiat monetary system, which has lost roughly 85% of its purchasing power since the end of the gold standard in 1971. Ultimately, the Austrian school teaches us that competition, not central control, should decide which form of money best serves society. If you enjoyed this Austrian analysis, give the video a like, subscribe, and drop a comment. Gold, Bitcoin, or both, and why? Thank you for watching. See you in the next one.